Good morning, ladies and gentlemen. And once more, I have to apologize. This wrist dial is completely wrong. It's just not updating. As you can see, it's just copying the data from the previous day. And actually, from what I've done manually, the calculation, the wrist dial is now at 0 or at -5. I can't be absolutely precise, but from the manual calculations that I've redone, that's where we are. We still cannot fix what's wrong. It's going to take another couple of weeks. Please bear with me, I'm very sorry, but I will update you in these videos as to my manual calculations where we are. In any case, you know, the maths was right. We are in risk off, and we continue to be in risk off on all these time frames. And now I will examine what has changed last week and what I think is going to happen next week. The yield curve in the US definitely has a flattening tendency. You can see here in the 2s, 10s that we just couldn't keep up, you know, these levels in the 90s, and we've, you know, this is the second lowest close we've had in the 2s, 10s. To me, this is going down into the 50s. That's basically where we're going. The direction of travel, the yield curve is unmistakable. It's a flattening yield curve in just about all the tenures. That, you know, tends to forecast a slowdown in the economy caused by the Fed's tightening. The fact that the long tenures are just not keeping up with the move in the short end suggests the terminal rate will not change very much. I'll examine that, but definitely it's a flattening tendency, and I really see the 2s, 10s down into the 50s at some stage in the next few weeks. 530s, much less than the 2s, 10s, but still the direction of travel seems to be towards 0. You know, the previous high was here at 21 basis points. We are going there. Now, we've taken out the previous highs here as well in the 10s, 30s, suggesting that the 30s are the most stable part of the yield curve and everything is reaching up towards their level. The 30s are the terminal rate, and you know, the direction of travel in whatever you look at seems to be for a flattening yield curve. Absolutely no doubt about that. That is worrying insofar as a flattening yield curve. A flat yield curve tends to presage a slowdown, slow stroke recession. Quite how we're why we would have a recession in the US when the data is, especially the employment data, is so strong, I don't know. But that is what the yield curve is saying, and it's unmistakable. If anyone says that the move in equities was caused by the bonds, all you've got to do is look at these charts of the 5s, the 10s, and the 30s and see that actually nothing happened in the bond market last week. We tried higher yields, didn't sustain them, came back down, closed with basically a doji, hangman doji. You know, it just nothing happened in the bond market. The 10s, if we look at those, you know, I'll enlarge this weekly chart. What happened in the 10s? Well, we closed on the lows, suggesting that we are actually, we have the FOMC next week, as you know, but, you know, suggesting that the 10s are certainly not the area that's going to get very, very hit. If we actually have a look at what the IEF ETF did, it's suggesting that we're going to go back towards this area, 114, 115 next week, 114 and a half. that kind of thing, which would be, certainly another indication of potential risk off. I really don't think that the problem is in the longer end of the yield curve. The problem is in the shorter end. The problem is in what the market is afraid the Fed might do. But until and unless we start breaking these areas, really the problem is not in the long end of the market. Let's have a look at what happened in the 30s. This very much suggests that we are going to remain around the 2% area in the 30s, and the fact that we bounced so hard off this level in TLT, if I enlarge that, suggests that we're going to remain stable in TLT and trade somewhere around between 146 and 142. Still suggesting the same terminal rate as we've been suggesting for what is this, best part of a year, give or take 30-40 basis points. So the problem is not in the bonds. The problem, I guess, is in some slowdown that the equity market is predicting. Europe is doing not very much, but that is also indicative. I did think that this is not the right timing. This is the Schatz, the 2-year. Basically, this level is going to be very hard to break in the short term. The position you want to put on is in this area, is around -67, between -64 and -67. This is the risk-reward area for higher yields. If we have a look at the bobble, which is the 5-year area, this is again where you want to put on the short positions around the -49 area. This is where the risk reward is going to be excellent. Again, we closed the week. If I change this to a weekly chart, we closed it, we tried the absolute level. We ticked exactly where I said it would go, and now this is the area that we want to wait for it and get ready for it to go back up to that area. That's the risk-reward area. If we look at the bonds, same thing. Can't hold. This is a weekly chart. Can't hold there. This is where you want it. You want it somewhere around the -24 area. If we change that to a daily chart, this is it. This area here. This is basically a retracement of the move. If we get to the -24, this kind of area, this is where you want to have a long position in yields and a short position in futures. I know these are quite big moves, but it's, I think the FOMC is definitely not going to say anything much that we don't know. In fact, the fact that we had such a bad week in equities and that people are so afraid of higher rates could spur a much more dovish tone to the presser. Nothing is expected to be decided in any case in terms of rate movements, and that could give us a nice move into the areas which I reckon are going to be very good risk rewards for another move higher in yields later on. Now, the differential between Germany and US is not moving very much, suggesting that the terminal rates, it's suggesting the first thing it suggests is that QE leaks. That the QE from Europe and from Japan will leak into the US. And at some stage, I still think that the likelihood is that we break lower, and that will be a very big signal. To me, whether we are 183 or 196, yeah, big deal. The big deal will be when this actually reverses. For the time being, I really don't think there's very much to do in bonds, but wait for them to reach the levels that are good risk reward and still put the position on shorter futures, because that will be the direction of travel for the rest of the year. To me, the idea that the Fed needs to do very much to slow down inflation is fanciful, simply because one of Jay Powell's favorite indicators, which is this, is just at the same level as it was at the beginning of 2021. Headline inflation might be 7%, but we are no different from we were in 2018. And we can even go as far back as you like. We can even go back to 2008, and we are lower than we were in 2008, and we are basically at the same level that we have been throughout 2013, 14, and only slightly higher than we were in 2016, or 2015. So really, the idea that the Fed needs to hike rates to ridiculous levels above 3-4% in the short end, to me is very fanciful. I think rates will be around the 1.5% to 2%, and it will be a flat yield curve throughout all the tenures from overnight out to 30 years. That is what these inflation expectations are suggesting. Even if we look at the 10-year break-even inflation rate, well, is that, and this is, 10-year, how high is that? This is basically the same level as we were in 2013 and 2014. It's just very fanciful to me that we are going to need much more than the market is already predicting. And since that is what the market is predicting, I think all the pressure then is going to be on other countries apart from the US. The US is already where it needs to be. The pressure is going to come on Europe, on Japan, on other countries. To me, the US terminal rates are pretty much set. Quite a boring week in the dollar. I don't have anything to add from what I've been saying for the past several weeks. And that is, until we start breaking above 96.47, there is really not very much of a trend. Support holds around 95.07. The reason why we are unlikely to go very much lower is the geopolitical risk with Russia and Ukraine. I think that's, if it happens, when it happens, it's going to be a 1, 2, 3, 4, 5 day flash in the pan, and that's going to be it. To me, the real signal will be, do we break 98.54 or not? Otherwise, this is just a quick retracement. If we can't break 98.54, to me, that is a very good level to start looking for a retracement in the dollar, simply because I still expect at some stage this year those yield differentials between the US and Europe to completely change, flip over, and favor the US in terms of lower yields relative to Europe. And therefore the pressure should return on the dollar, on the DXY, to go lower. For the time being, you are caught between the euro and the yen, and DXY is just basically ranging. The yen could have a rapid move in risk off. Yes, it could, but I don't think even that lasts. And therefore, I think the DXY is basically in a range. If we have a look at what that looks like for Euro USD, well, we've turned the 200-day moving average on 200 period moving average on the weeklies, suggesting that we continue to have downward pressure. We have a negatively sloped 200-day moving average, suggesting that we keep the pressure on. The question is, when do we break these levels to the downside and trade around here, around this 100 and what's that, just above 110, 110.40. That to me is the direction of travel. Again, 115.50, probably not a bad area to buy some puts in Euro USD. Gold is just proving once again that it's still a trading instrument. To me, this is a monthly chart, and I'll enlarge it like this. This area between 1839 and 1829 or whatever is very, very important on this monthly chart. If we can't break and close above it, the pressure will return down towards 1764, pardon me, at these levels here. What am I worried about gold? Why am I not max long gold? I'm not absolutely convinced that the dollar has topped out. And B, I don't think the geopolitical situation necessarily favors gold. It is quite possible that the market starts anticipating that Russia will actually sell a lot of gold if very stiff trading conditions are imposed on it, and it's not able to sell its gas to Europe. They will have to have a source of foreign exchange, and I don't know what else they can sell apart from gold. They have huge gold reserves, and they could dump some gold in order to obtain dollars or euros or whatever it is they need for trade. If it's up, if they can't have gas sales and petroleum sales in general. So that is probably why gold is not going to do very much for quite some time. If we look on, is gold repairing itself on a weekly and on a daily basis? Yes, we're slowly turning these moving averages. Yes, we keep on closing above them, but really it's pedestrian. There is absolutely no impulsion here, and moves back down to 1764 certainly on the daily cannot be excluded. I keep on trying to buy it and trade it from the long side. It works, but it's a trading instrument. I still don't think we are in trend. I still don't think there are any reasons to do anything but trade it. The DBC over gold chart still very much favors DBC. No change here, and really in a week which should have favored gold with all the reversal in bonds, with the dollar not doing very much. The fact that DBC is still gaining on gold just shows you that the pressure is going to continue to be on the downside, and until this 638 point. If we look at what DBC did on a weekly basis, well, it closed up for the fourth week on the trot. To me, that it really has to make up its mind. It wasn't a very a very strong close to the week, because this is a weekly chart again, but I still think all the pressure is up and that we need to trade this 24.39 area. And that to me will be the signal to get out of DBC and favor gold and favor bonds and things like that. So we'll probably have another, a couple of weeks of consolidation here, allow these moving averages to, allow these Bollinger Bands, weekly Bollinger Bands to expand and then go up to 24. But to me, DBC is still very much to be favored over gold as an inflation hedge. And really, that's all I have to say. The likelihood of oil falling out of bed is very, very low unless we have a recession. And the fact that we didn't fall out of bed in CL last week tells me that this idea that we're going to have a massive slowdown in the US is actually a bit fanciful. And talking about CL, to me, I would not belong here. This is a very important area around this 85 level. The fact that we are really struggling to close above it suggests that the pressure might be for a return down to 75. And that is why I think there's consolidation ahead for DBC for the next couple of weeks, which could easily lead to gold being under pressure as well, back down to at least, that 1800 first support. And that's why I think all these things are still trading. The ones which are in better trends are CL and DBC, and gold is just a trading instrument. So, I do like buying dips, but where dips down to dips down to this kind of level, low 60s, I think there's value in CL. Could we be in a trading range for quite some time between 65 and 85? Very possibly. And that would actually require other areas of DBC to perform if we're going to get to the 24 level. So, turning cautious on just about everything. Before we look at the individual indices, let's have a look at a few spreads. This is XLP over XLY, and you can see what it did last week. It went straight, it bust through and went straight to resistance overhead. Whether we break through this resistance or not is, I think, very, very important for next week, because if we do, we are going to go to around 45 area, and we're now at 42. From 42 to 45, it's 5%. So that would be the magnitude of the move of this spread, which would certainly give us at least a couple of percent down in the S&Ps. Is it really surprising? I mean, it's obvious that we've gone into risk off, but could this be the absolute top? Yes, it could. I'm not really that worried. I really want to see what it does next week. This is not the kind of move that really would worry me normally, and it's not worrying me. I think this is the normal kind of market reaction when the market is exhausted to the upside and people are fearful and there is a risk-off move. But what it does tell me is that the problem is not with XLP. The problem is with XLY. All this move is actually Y. It's not P doing anything. Then the question has to be why. What is the problem with Y? Why are people starting to discount the US consumer being being tapped out? Employment is so strong, it seems odd. But if the US consumer is tapped out, we have a big problem in all the indices. Now, this is the semiconductor socks against FXY, which is the yen, and it tends to be one of the strongest indicators of risk on, risk off, and one of the very leading indicators. And that, as you can see, is basically, it broke very hard last week. And this kind of level, if it can't return above it, it will be another indicator that we probably have quite a bit of room to come down. You can see how it held the risk on trend for such a long time. And it was the leading indicator of telling me that we weren't going to really suffer in the technology space from the coronavirus of early 2020. It broke very, very early and continued the trend, telling me to keep long of NQ. Now, if you can't regain this kind of area, over the next couple of weeks, it's going to tell me to get the hell out. This is RCD over RHS, so it's equal weight consumer discretionary over consumer staples. And it's coming back into an area that is, very, very usual for it to trade in. This is all going all the way back out to 2017. This tells me that the process of adjustment is not very far from its end. Was that another 2-3% in equal weight terms? That's this kind of area, another week's worth of bleed, and then some kind of retracement. That is what this one is telling me, that we are not that far away from a bottom. And that one is the one that's encouraging me. Now, I think these two charts are becoming more and more important, because to have true risk off, you need the bonds to start taking up some of the slack. If all we're saying is that bonds remain stable, then I really don't see how we can have a true collapse in equities, because equities are not expensive. I keep on saying this, relative to bonds, they're not expensive. The only way equities come down is if we have some kind of a recession in the US and we start flipping over in terms of expectations of forward earnings. That is not going to happen in a day. It's not going to happen in a week. It's not even going to happen in a month. So to me, as long as SPY over IEF can really not correct any more than this kind of level, 371, and as long as QQQ over TLT can't really go below 234, which is the levels that basically we've held since the middle of last year, all that will have meant is that we've had a healthy correction in the market, and then we can start retracing upwards. And this is also the reason why I think we will revisit the scenes of the crime in the indices of last week. I will examine what those levels are in detail, and that is when we will make a decision. To me, the idea that we just keep on continuing to go down here without IEF performing, i.e. just all the downdraft being caused by SPY, is frankly ridiculous. And I'd bet every cent I have against it. For this to start breaking down, you have to have bonds performing, i.e. the economy is going to hell. I don't want equities, I want bonds. And bond prices, bond yields have to go down and futures prices to scream higher. As long as that is not happening, the adjustment between SPY and IEF and QQQ and TLT can only be limited. And this is what I'm seeing on these charts. Now, is this the start of a trend lower? Well, we will only know that once we've retested these levels. okay, and we failed once we've retested these levels here and failed, but a retest we must have. Having had a look at what the important spreads are saying, let's have a look at what volatility is saying before we look at the indices. We are still below the levels that we were in early part of December, and we are still below the very critical to me weekly 31.06 closing level. You know, the volatility just does not leave gaps. It always fills them. We had this gap to here to 27 and we filled it. Now we have a gap down here at 21.37. This to me says that at some stage we will trade there, and that will be the crucial time when we decide. What is interesting is that the 200-day moving average is now starting to turn upwards, and all these moving averages are turning upwards. Could it be that 20.05 now becomes the bottom of the range? You know, switching over to a weekly chart, and I'll enlarge this one. It could easily be that we are shifting regime, and that the low 20s are all we are ever going to see again for quite some time. It could be. It could very well be that this whole area here will never be revisited, and that we are in this kind of regime as the low. But that still gives you that kind of low around the 21 area at some stage. And that is another indicator to me that the scene of the crime will be revisited. Now, let's have a look at where the scene of the crime is. And let's start off with the weekly chart. Okay, first time since, early 2020 that we have broken the uptrend in the weekly chart. This is bad, okay? This is bad. And really you can see that everyone who is long in this area up here is now trapped. What is the scene of the crime? The scene of the crime is 45.35. That is when we broke down through there. We accelerated lower on all these stops. As you can see, we have the Bollinger Band now at these lows. I think that if we get there, we take them out just for the sake of taking them out, and then the real support is going to be 42.47 to 42.32. I would really be surprised if we can close the week next week below there. But I also think that from there we have a move, certainly a move up to 45.35, which is the scene of the crime. I've seen this so many times over the decades. The S&P always returns to the scene of the crime. You know, people don't believe it can. It does something. You know, whether it takes 1 week or 5 weeks, I don't care. 45.35 is going to trade again, and that will be decision time. Because then, if we fail at 45.35, we probably have quite a bit to go down to, and I wouldn't be surprised if we see this kind of area, 3,940, 3,870. That is the kind of area that it's quite likely to trade if we fail again when it revisits 45.30. For next week, I think the Bollinger Band, Monday might be hairy. There is no way that Tuesday can be, because people are not going to want to take the market, and that's probably better seen on a daily chart. I mean, we are outside all of the Bollinger Bands. We are below the 200-day moving average, but the market hates to have to be in below Bollinger Bands and ahead of a significant event like the FOMC. It likes to be much closer to these moving averages. That's why I think that 45.35 can come at any time next week. And that will be the important level. At that level, really, you want to buy volatility or straddles, rather, whatever happens, because it's either going to go through it, in which case we are going to make new highs, or we're going to basically say that whatever this was, wherever the low is probably only halfway of where we need to be. NQ has done far more than SPX, and that's really not surprising. And, you know, there is no reason to think that that actually is going to continue. And that makes me optimistic for indices next week, that we will not see a complete collapse, and that in fact we might even see a return to the scene of the crime in all of them. NQ, really the level to start looking for a bounce is around this 13,800 to 14,000 level. That is the next level that I'm really looking to look for a serious bounce. And where is its scene of the crime? Where the scene of the crime is 15,111. Call it 15,200-ish. That is its scene of the crime, and I think that we return to at least that kind of area, if not 15,300. 15,200, 15,300 is its scene of the crime, and I think we'll return to it and then make a decision which way we go. Again, I'm not being bullish for the sake of being bullish. I'm being bullish for the sake of logic. You cannot have true risk off, as I told you before, without bonds being in trend. Everything else is just a technical retracement. Why it's happening, it's neither here nor there. The only reason is that people are fearing something, anticipating something. But the fact that they are fearing it does not make it true, does not make it come true. We need to see a battle between people who believe it'll happen and people who believe it won't happen, and then get confirmation from fundamental data for one side or the other. Markets don't change on a tuppenny bit. They don't swing around this quickly without some kind of confirmation from the fundamental numbers, and that takes time. If we look at the individual stocks, we can actually see where the true problem in the indices lies, and that is Amazon. Now, it closed below 29.06, and the level where it bounced from like hell on Friday and gave us a 50-60 point rally in the S&Ps before they gave everything up as Amazon just fell apart. And that is the reason why I look at Amazon, and is because it's a very important forward indicator of the consumer, isn't it? I mean, let's face it. And that seems to be where the problem lies, and that seems to be where people are saying the consumer is tapped out. Could it be? It could very well be. I mean, I have no crystal ball, but I think for this to continue much more, I mean, let's face it, it should continue down to this kind of level. 2,528, 2,530, whatever it is, and that is still quite a lot. But that is the only stock of the big boys that is in deep trouble. All the other stocks, and I'm not going to show them now because you can have a look yourselves, are really not showing anything but, slight corrections. The one that is showing a deep correction and a deep problem is Amazon. So we have to keep on watching Amazon. I mean, of course, it's hugely oversold, but that doesn't mean anything. It could still go down for a couple of days and then bounce. But at some stage, I think even Amazon is going to retest the 2,906 level, after maybe, and that is going to be the important time in the index. When Amazon traded, everything else can do a little bit better. Amazon retest 2,906, and S&Ps are back at 3,000, 3,535, and that is the true test. At some stage, we retest this, and if we fail then, whether it's in a week's time, a month's time, I really don't care, but that will be the signal that if we can't break above it, that yes, the people who are fearing a slowdown in the consumer, that the consumer is tapped out, are right, and then we can really start going down on Amazon. That will be the best indicator, as far as I'm concerned, that Amazon can't regain after a period of weakness, and the retracement really doesn't take out 2,906 again. The transports have also broken down, and so has DJI, and the returns of the scene of the crime is going to be 15,900-ish, and here 34,800, let's call it. I'm convinced that those levels will trade again, and those will be the important levels that decide whether we break down or make new highs. The interesting thing is that all the charts are more or less, all the index charts are showing more or less the same thing, that the market is currently deeply oversold. What's new? That doesn't give me any confidence there's going to be any kind of lasting bounce. But I do think they all have to trade the scene of the crime, and the fact that we have FOMC on Wednesday suggests to me that after FOMC, that is where they will trade, and that's where the decision comes. It's going to be very, very interesting. If we fail at those scene of the crime levels that I've seen so many times retested over the decades, I do think that then we are in trouble. But we need a reason to be in trouble, and I really can't see it at the moment. And the thing that makes me absolutely convinced that we'll retest that 4,538 level is because we have the Blue Angels still rising. Every time the Blue Angels are rising and the market has a bit of a panic, and you will see here is one occasion, we always retested them. And even in 2008, in early 2008, even when they were flat, were going down, we still retested them. The only thing that could make us go down to 18 times is if bonds now start going up in yield and we have a new terminal rate, which is not going to happen, which is not happening. And then I would get really, really bearish. If bonds start going up in yield, you can forget about, retracing anything. But as long as that doesn't happen, and I think that Powell is more likely to be dovish than not, seeing the market reaction this week, I really can't see us not retesting from underneath the time 20 Blue Angel. So the fundamentals and the technicals more or less coincide. I want to buy the dip when it gets to this level, and technically that level is, we will see in the next slide. And when things get hairy, I always go to my clean long-term chart. and enlarge it. Now, to me, the level that is going to be absolutely key next week and going forward is 4,255. If we start panicking on Monday, and then why not? Let's continue panicking. These stops here, and there will be loads of them just below this kind of level, 4,270, are going to be, everyone's target. You've got to take them out, and just below it you buy. For a return to the scene of the crime, 4,535. To me, that is going to be the move, and then we see. It might take several days, it might even take a couple of weeks, but that is the kind of price action that I'm expecting. Basically, a trading range between 4,255 and 4,535, and then we decide. Was I expecting this? No. Do I think equities are expensive? No. I think they are relatively cheap to bonds. If bonds don't go up, I really can't see that buying a panic is the wrong thing to do. As far as the other indices are concerned, the levels of concern in the Nikkei is 26,910. Below there, and we really are beginning to break down. If we have a look on a weekly chart, really we can't afford to go any lower than 26,195, and that probably will be a decent level for a bounce and the return into the 28,000s. Europe also is very much much stronger than the US. You can see how we only came off a couple of percent, but really the levels to start looking for for a bounce in Europe are here around the 4,019 on the weeklies. If we look at the DAX, that level is around the 15,000 level, and if we look at the stocks, we are still above the 200-day moving average. To me, the key is going to be 4,141, and in the DAX, this kind of level, if we break around these kind of levels, the 15,100 level, 15,200 level, those are going to be key. If those hold, then I think that we have quite a bit of a rally in the S&Ps, a bounce off the levels that I discussed. But 4,141 to me is going to be very, very important in the stocks. And as long as we don't go much below it, but we do something like this, 4,090, then I'm sure that we will bounce back towards the 4,200 area. And with that, onto the buyer sheets. Now, as you have probably gathered, the one thing that I'm worried about is the US consumer, because all the trouble seems to be in the stocks, which show the interplay between staples and discretionary, and then the biggest stock that's having trouble is Amazon, and everything is saying that it's the US consumer that's going to be the problem. Could that be because inflation is eating away at his purchasing power? They've spent all the money from the previous help that they got from the government. Whatever the reason might be, that is what the market is saying. The problem is with the US consumer. If that is the problem, that is a big problem, and the market will go lower. There's absolutely no doubt about that. But what does that actually mean to us? That means that that retail sales how much credit is extended, and that kind of, the visa numbers that come out that tell you what the credit card spend. All those things are going to become far more important in the future and that is the data that we need to be particularly sensitive to over the course of the next month or so. Anything that shows that the US consumer is spending below expectations, anything that shows that they're not buying, is going to have an outsized effect on this market. Having said that, I've updated all the everything here in the in the buyer sheet. I think the key is going to be if the consumer is tapped out, then we could easily see a shift even lower in the yield curve, led by 30s. And because let's face it, the Fed can't really back out from some interest rate increases. And that is why I keep on saying that I really would not be surprised to see a flat yield curve at around the 1.5% to 2% level at some stage. And that is really what is worrying. The worrying thing is the US consumer, and the worrying thing is the flattening of the yield curve, which anticipates a contraction or recession. Thank you very much indeed, and tweet you on Monday.